Hello students, this is Vaibhavi and we are going to learn about how to calculate long-term ratio. Today we are going to learn about concept of long-term financial position or solvency ratio. 1. Debt equity ratio. 2. Proprietary ratio. 3. Solvency ratio. 4. Capital gearing ratio. 5. Fixed asset to net worth ratio. 6. Ratio of current asset to proprietary fund oblique net worth. 7. Ratio of current liabilities to proprietors fund. 8. Fixed asset to total long-term fund. 9. Debt service ratio or interest coverage ratio. Long-term financial position or solvency ratio. Sometimes company takes a loan from the creditors or financial institution for a long period of time. The company is said solvent company when it has the ability to pay long-term dues. The company has to pay interest on dues also. For example, interest on capital or debenture oblique loan. The following ratio reflects the solvency position of company. 1. Debt equity ratio. This ratio indicates the relationship between the total outsider liabilities and total asset of a firm. The outsider liabilities are also known as external liabilities or debts, while total assets of a firm is known as internal asset fund, oblique fund or equity. This ratio can be expressed 2 tends to 1 or 1 tends to 1 through a general rule of debt should not more equity. The ratio 1 tends to 1 shows reasonable long-term solvency. The ratio 1 tends to 1 shows reasonable long-term solvency. But when it increases, it becomes risk or harmful to the company. The debt equity ratio is expressed as debt equity ratio is equal to debt divided by equity or external fund divided by internal fund or outsider liabilities divided by shareholder fund. Shareholder fund is equal to equity plus preference share plus capital reserve plus undistributed profit. Problem. Suppose Vaibhavi Limited companies have the total asset of rupees 2 lakh has total liabilities of rupees 50,000 and own fund of rupees 1 lakh 50,000. Debt equity ratio will be debt. Equity ratio is equal to debt divided by equity is equal to 50,000 divided by 1 lakh 50,000 is equal to 0.33. It indicates the company has only 33% outsider fund and the company is more concentrating on its own funds. Second, proprietors ratio. This ratio is also known as capital ratio or net worth to total assets ratio. This ratio shows the relation of proprietors fund to total asset. The proprietors fund is called as net worth. The ideal proprietary ratio is 0.5 tends to 1. A higher proprietary ratio is better for long-term solvency point of view. The higher ratio indicates strong financial position, vice versa, and the following formula is used to calculate this ratio. Proprietary ratio is equal to shareholder fund divided by total assets or capital employed divided by total liabilities. Problem. Suppose Vaibhavi Company Limited has its own fund of rupees 2 lakh and total assets of rupees 4 lakh. The proprietary ratio will be as equal to proprietary ratio is equal to shareholder fund divided by total asset. 2 lakh divided by 4 lakh is equal to 0.5. It shows satisfactory result as per standard norms. 3. Solvency ratio. This ratio indicates the relationship between total asset and total liabilities of a company. Solvency ratio is equal to total asset divided by total liabilities. There is no standard norms of ratio in case of this ratio. This ratio is used to know the financial position of a company. The high ratio indicates strong and efficient financial position and vice versa. 4. Capital gearing ratio. This ratio indicates the relationship between and fixed interest bearing securities and equity shareholder funds. There is no standard ratio specified in this regard. If the company is having large fund bearing fixed interest oblique dividend than the equity shareholder fund, the company is said to be highly geared and vice versa. That is low geared if reserve position. If both the components are equal, the company is said to be evenly geared. This ratio can be calculated as follows. Capital gearing ratio is equal to fixed interest bearing ratio securities divided by equity shareholder funds. You should keep in mind the following components of 1. Fixed interest bearing securities, preferred share debentures, long-term loans and long-term fixed deposit. Second, shareholder fund, earning per shares plus reserve plus profit and loss account minus fictitious asset. 5. Fixed asset to net worth ratio. This ratio shows the relationship of fixed asset after depreciation to net worth or proprietary fund of business. It can be expressed as fixed asset to net worth ratio is equal to net fixed asset divided by net worth oblique proprietors fund. The ratio indicates the extent to which shareholders fund are sunk into the fixed asset. The standard ratio is 0.75 tends to 1. A higher ratio that is 100% means a company has utilized its own fund rather than outsider fund. A significant low dividend to shareholders and overcapitalization of a company. 6. Ratio of current asset to proprietors fund oblique net worth. It shows the relationship between current asset and net worth of business. The following formula is generally used. Current asset to net worth ratio is equal to current asset divided by net worth. This ratio mainly indicates that show how much proprietor's fund is invested in current asset. If proportion is of current asset to net worth is higher as compared to the proprietor proportion of fixed asset to net worth, it signifies the financial strength of the business. 7. Ratio of current liabilities to proprietors fund. It expresses the relationship between current liabilities to proprietor fund. Current liabilities to net worth ratio is equal to current liabilities divided by net worth. The standard ratio is 1:3. This ratio indicates the contribution of short-term creditor and other in capital formation of a business. A high ratio show difficulty in obtaining long-term fund. 8. Fixed asset to total long-term fund. This ratio is also known as fixed asset ratio. This ratio indicates how the fixed assets are financed with the help of long-term fund. The formula of this ratio. Fixed asset to long-term funds is equal to fixed asset after depreciation divided by total long-term funds. 9. Debt service ratio or interest coverage ratio. This ratio expresses earnings before interest and tax (EBIT) and fixed interest charges. Fixed charges include interest on long-term loans, deposits and debentures. The formula is debt service ratio is equal to earning before interest and tax (EBIT) divided by fixed interest charges. Normally, the ideal ratio is 6 or 7 times considered. It indicates the financial ability to pay interest. A high ratio means high margin of safety for the long-term lenders and vice versa. Thus, students, today we learn about concept of long-term financial position or solvency ratio. 1. Debt equity ratio, 2. Proprietary ratio, 3. Solvency ratio, 4. Capital gearing ratio, 5. Fixed asset to net worth ratio, 6. Ratio of current asset to proprietary fund oblique net worth, 7. Ratio of current liabilities to proprietary fund, 8. Fixed asset to total long-term fund, 9. Debt service ratio or interest coverage ratio. Thank you and see you in the next session.